This conference will now be recorded.
In our next to last new lecture, we're going to be looking at capital gain and losses, things especially dealing with stock. Stock is going to be our biggest item to look at here because that's the most common item we're going to have gain and losses on. We're going to see that there's a difference between having a stock for less than a year or more than a year. When you have an item for more than a year, it's considered a long-term capital asset. And when it's long-term, you get a special tax break. And the special tax break means you are going to be in one of these three percentages instead of your normal tax percentage. Your normal tax percentages are what we went through way back in the first week, where you're in different brackets, and you can always look at your text at the back of the book and see the tax brackets, or even if they're in chapter 1, I believe, we got the 10%, the 12%, and then it jumps up to the 22%, 24, on up all the way to like 37, if I remember correctly, is the top bracket. So you can see these percentages are quite a bit lower. And it's all depending on your taxable income. This is the key number. So remember, taxable income, that's not your gross. Your taxable income is your gross income minus any adjustments, and then minus your standard deduction or itemized deductions. So that's a pretty big chunk off of your income. So taxable income is always going to be quite a bit lower than what you actually bring in from your paychecks. And so you'll see here, if you're married and your taxable income is less than $77,200, any type of capital gains you have, so you held your stock for more than a year and you bring in $7,000 in gains, you're not going to pay any income tax on that. That's going to be a great benefit. And even if you do make quite a bit of money and you're in one of those upper 20 plus or in the 30% brackets, regular taxes, you're only going to pay 15% on those capital gains. And then the highest you could pay is only 20%, which is still almost half of your normal tax bracket. It should be noted then, any type of collectibles that you have, the main would be like a baseball card collection, an art collection, or a stamp collection. Anytime you sell those for a gain, they're automatically taxed at 28%. That's just a set number. When we talk about stocks, mainly these capital gain type items, they're called portfolio income items. And if you remember back to way back, I think it was week 2, maybe perhaps, or maybe week 4, we talked about the difference between there's active income. There were 3 types of income. Active, meaning you actually work at a job or you own your own business. And then there's 2, this portfolio income, where you make money primarily on interest or selling things for a gain or loss. And then 3, the passive, which a lot of it deals with either passive partnerships, which is way beyond this class, or real estate, which is what we talked about last week. Well, this one falls in that second item. And you can't offset these items against each other unless there's a special rule. So last week, the special rule with the real estate was, as long as you met the income guidelines, you could take $25,000 up to $25,000 in real estate losses off your regular income. With the portfolio income, it's not nearly as lucrative. Whenever you have a loss, you can take only up to $3,000 of that loss off of your current income. Any additional losses above the $3,000 can be carried forward indefinitely, which means you can carry it forward for however long you need to be able to use up all of that loss. Now, if in the next year you have a large gain in stocks, then you can offset all of it perhaps, because you can offset gain and losses within the same category, portfolio. It's just if you have any left over, you can only take $3,000 a year actually on your tax return as a loss. Notice here the personal use assets, such as like your car, maybe your tractor, whatever else you may have and own, that you buy it, use it, and then sell it for quite a bit lower just because it's been used and it's a lot older. You can't take any losses for personal use assets, just something you got to know. Now, stocks aren't personal use assets. Those you can take losses on. However, if you did happen to have a gain on any of those said items, like a car, tractor, anything that you own that's a personal use, you technically would have to record that as a gain for tax purposes. Now, if that ever really happens, can't hardly say. It would be kind of hard for the IRS to track that, but that is how the tax law is written. With short-term capital assets, items that you hold for a year or less, there is no special tax treatment. You have to pay tax on your entire normal rate, just like you would if you made extra money in your job. But you still are allowed to take the $3,000 in losses. So for losses, it doesn't matter if it's long-term or short-term. It only matters if it's a gain, because if it's a gain, long-term, you get those special rates up above. So when you have a capital gain, yes, you do include it as part of your taxable income. When it comes down to actually finding how much tax you owe, then you have to temporarily exclude it back out if that capital gain is a long-term gain. You would take it back out, that amount that was capital gain, find the tax on whatever's left, and then add in the capital gain rate separately. And we're going to see 2 examples of that coming up, because I know that's kind of hard to understand just with words. If you, when you sell a stock, if you have more than one item happening, you always want to net them down as far as they can go. And you're going to see here what happens when you net. The first thing you always do is you net all your long-term items, whether they're gain or losses, and then net all of your short-term items. Then whatever's left is going to fall into one of these 4 categories. If they're both gains, when you're all done, you've netted the short-term and the long-term, and they both end in gains, then the short-term is going to be taxed at the regular rate, and the long-terms we're going to separate out and tax at the lower rate. If they are one of each, which is B and C, then we're going to net for one final amount. It's either going to be one short-term gain or one long-term loss, and then the other way around, and then we're going to tax accordingly. If they're both losses, it doesn't really matter how we record them, because losses, they don't have a difference on how they're treated for tax purposes. You can only take $3,000 in losses. So let's look at this example. I have 4 different stocks that I'm going to be selling, and let's pretend that I'm a single individual with taxable income of $50,000. Now that taxable income of $50,000 is going to come into play, because that's going to show that I'm in this middle category at the very bottom of it, but unfortunately I'm still in this category. So any capital long-term gains are still going to be taxed at this higher rate, the 15%. And if I make $50,000, then my normal rate is going to be whatever the tax tables would have said, and we'll look those up in a few minutes when we get to problem C. All right, so we're going to net all of our long-term gain and losses and our short-term gain and losses. So we're going to net these 2. When we net our short-term and our long-term, our short-term gain and losses, we get a net short-term gain of $1,500. And then when we net our long-term, we also have a net long-term gain of $1,500. So how is this going to affect on our tax return? Well, our taxable income is already, this $50,000 already includes these amounts, these 2 nets, the $1,500 for short-term, $1,500 for long-term. So how this is actually going to be taxed when it's all said and done, let's pull up the answers here. The short-term gain of that $1,500 is going to be taxed at my normal rates. So therefore, and I'm going to tack this in here, we're going to look up $48,500 in the tax tables, because remember we started with 50, and that $1,500 we keep it in there, we don't take it out. But with that long-term gain, we do take it out. So that's why this came down $1,500 from $50,000. And we're going to tax this, and I already looked it up, and we'll do this as we get further along. But this one, the 48,500, if you have that taxable income, you're in the 22% bracket. So with this long-term gain, we're not saving very much because we're only in the 22% bracket and we're only saving going down to 15. So it's not a huge benefit as it would be if we were up in the $400,000 range. Then it is a huge benefit. So this individual did not fare all that well, but still anything helps. So the 1,500 long-term is taxed at the lower rate. The 1,500 short-term would still be included with the regular capital, with the regular income and tax at normal rates. All right, so what I want you to do is on A2, you try this one, do the same thing, and let's see what you get. Pause the video and we'll start it up here in a few seconds. All right, with A2, when you combine them, we would have a short-term gain of 2,000 and a long-term loss of 7,000. And if we go back to the rules say if we have a short-term gain and a long-term loss, we net for one final amount. So when we net these two here, we're going to have a long-term loss of $5,000. And then recall what we do with losses. With losses, we can take up to 3,000 per year to offset. So on our Schedule D line, which is on Schedule 1, when we're looking at the 1040, just below the business income. So it's line, I believe it's line 13, if I remember correctly, on Schedule 1, we would have a $3,000 negative, because that's the most we can have. And then we would have on our Schedule D form showing a $2,000 carry forward loss. And we could use that going into the next year. If we didn't have any more losses, we could use all the 2,000 next year because we can go up to 3,000 potentially. Okay, we talked about the difference between realized and recognized some last week, but just as a kind of a recap, realized gain and losses is what actually happened. Think of this as like accounting 101. Without any type of tax rules, this is what happened, realized. Recognized then says, well, I know that's what you really got, but for tax purposes, we can only do it this way. So that's what is considered recognized. And the four rules that I've come up with over the years with recognized gains, these are things you'll just want to remember. Recognized gains will never go above and beyond a realized gain. You won't have more gain than you would have had without any tax rules. So that'll never happen. Your recognized gain can definitely be less than your realized gain. So it can't be more, but it can definitely be less. It can definitely be zero. Your recognized gain can be zero. And if you have a realized gain, it'll never be flipped to a loss for recognized purposes. So if you have a realized gain, it'll never be flipped back to a loss. All right, so let's look at our example B1, remembering everything we've looked at so far. If we purchased a car back in 2007 for $10,000 and we sold the car in 2018 for $2,000, what is the tax treatment? And what I mean by that, let's go through, let's answer what the realized and the recognized gain is. So our realized gain or loss would be, well, we bought it for 10. Personal use assets, you don't depreciate them. So it still has a value of 10,000 for us personally. We sold it for 2, so we technically have a loss of 8,000. But for tax purposes, you can't record a loss for personal use assets. So our recognized loss for this item would be 0. Realized loss was 8,000, the 10 minus the 2. Recognized loss is 0 because it's a personal use item. All right, on B2, we purchase a lawnmower from eBay. Say we bought it really cheap, $200. We sell it 2 years later for $700. What is the tax treatment if we are single with taxable income of 31,000? All right, I give us this 31,000. We need to go back up to my chart and see where does 31,000 fall for somebody that's single. They're in this really beneficial range where any kind of gains that they have, they're going to be taxed at 0. So yeah, we have a gain, but it's not going to really hurt us. We have a gain because we sold it for 700 and we bought it for only 200. So we have a realized and a recognized gain of 500, but that 500 is not going to be taxed. It's taxed at 0%. So you're going to have $0 of tax on that $500 gain. It didn't really hurt us, although the only thing it did is it did increase our gross income and our taxable income by that 500. It's just that in the end we weren't taxed on it. So on some things that look at, well, what's your adjusted gross income? This did hurt us a little bit. It upped it by 500, but the ultimate tax, it didn't hurt us at all. All right. Now we're going to look at with this example C1. What I want you to do is, if by the time I have you pause the video, I want you to get your book and look up. We're going to look up in the back of the book what this person would actually pay in tax liability based on their gain and losses and based on the existing taxable income. All right, so with this example C1 here, this person has a $90,000 taxable income. So that's already subtracting out their standard deduction or itemized, whatever they had. And it includes any gain or losses that we would find here with these Dell and Walmart stock occurrences. So knowing that those gain and losses are tacked into this, we're going to need to know, do we need to take anything out? And then how much are we actually going to look up in the back of the book? And then how much are we going to look up and tax at the rates from our example, from our table up here? We're going to look up the taxable income. So this individual with taxable income of 90,000, they fall in the 15% range, just barely. So they're going to be kind of hurting more than somebody that would be way up here. They're not going to get nearly as big of a benefit. But I'll walk through C1 with you, and then I'll have you try. I'll walk through C1 with you, and then I'll have you try C2 on your own. So if you haven't yet, go ahead and pause the video and get your book as we prepare to do C1. All right, so with C1, the first thing I want to do is determine the gain or losses and then any netting that needs to take place on these two stocks. So I see that the Dell stock would be a long-term item. Long-term, and it is a gain of 5,000. Long-term gain of 5,000. And Walmart, it was exactly 1 year. And the rule is, for it to be a long-term item, it has to be more than 1 year, so a year and a day. This one was exactly a year, so it is considered short-term. So the Walmart one, we actually had a gain as well for 3,000. So we had a long-term gain of 5 and a long-term short-term gain of 3. And if we think back to the rules, when we have two of them are both gains, we do keep them separate. And then how we're going to tax it is that we're going to take the long-term out. We're going to take the long-term out of this 90,000 that's already included in that number, because it's going to be taxed at a special rate. It's going to be taxed at 15% instead of the normal rate. Whereas the Walmart stock, with it being short-term, it's taxed at normal rates, so we don't take it out of this number. So when we go to the book, the back of the book, to look up how much tax is owed for C1, what we're going to look up is 85,000, not the 90, because we're going to take out 5. We're going to look up 85,000, and then the extra 5 that was a long-term capital gain, we're going to tax that at 15%. So our final answer, when you go into the book for somebody married filing joint at $85,000 taxable income, you get this amount, and then we add in 15% tax on the $5,000 long-term gain and a total tax liability of $11,335. Now, I want you to do everything the same, except we're going to assume that the Walmart stock was originally purchased for $25,000. So now there's going to be a loss on this one. How would you calculate C2? So pause the video, think it through, net your long-term and capital, net your long and short-term gains, and then look up the actual tax. And let's see if your answer is the same as mine. Okay, so when we have C2 coming up, we're going to see that we still have our long-term gain of 5, but now we have a short-term gain, a short-term loss of 10. When they're two different, when one's a loss and one's a gain, we net them. So now we have a short-term loss of only 5,000 combined. Remember, you can take up to a $3,000 loss on your income. So we're going to take 3,000 off of our 90, and we're going to look up 87,000 in the tax tables. 87,000, if you look that up for married filing joint, is 11,025. So I'm going to just briefly change this. When I say that it's 90,000, taxable income includes the gains below. I'm going to put if any, but not the losses. All right, I think that'll help. All right, so we've kind of got a look at how gain and losses are treated for tax purposes. Now, what happens if say a stock or something of a collectible nature is transferred down to you through an inheritance? With an inheritance, it's actually very good tax treatment because A, it's always considered long-term, no matter how long the person when they died had it, even if they only had it a couple months. When you get it, then it's considered automatic long-term, so that's a good thing. You get your special tax treatments. And the second good thing is the basis is always bumped up to the fair market value at the date of death. And this is known as the stepped up basis. So whenever you hear these terms in tax talk, if you hear a stepped up basis, that means that the heir, when they get the item, they get it and get to record it on their books. So whenever they sell it later, they get to record it at the fair market value, not what it was originally bought for by the person who had just died. So that's really good. And you can see my little example here. Say somebody bought stock a long time ago for $3 a share, and now it's worth 30. So there's going to be a pretty big gain here, especially if they have lots of shares. There's a $27 gain per share. But when that person dies, the heir gets the stepped up basis, meaning that now the stock to them is worth $30. And if they turn around and sell it for 30, they don't have to record any gain or loss. It's a really good benefit with an inheritance. You get the stepped up basis. So if somebody's about ready to die and they don't know if they should just gift an item to you now or wait till they die, a lot of times if there's no other factors involved, now there could be family fights, it could be a lot of different things involved, but if there's no other things involved, then you should wait and have it taken out after the death, as long as it's clearly stated in a will, and then you get the inheritance, you get that stepped up basis. Whereas if it's done before death as a gift, then it's not so clear and you don't get nearly as good a tax treatment. So let's look through what happens with gifts. So there's two possibilities. When the donor gifts something to you, it's either worth more or less. And of course, if it's worth the same, there's nothing really to worry about. It's going to be exactly what it's worth. But when it's worth more or less, then how are you going to know when you turn around and sell it if there's a gain or a loss? So in my little example here, what if the donor's basis say call it 10,000 in the stock, is less than what it's worth now. It's worth 12,000. It's gone up a little bit. What happens when the donee, say the daughter, gets it from her dad? The daughter will use the original owner's basis and as their basis, and the holding period will stay the same. So if the donor had it for more than a year, then that means that the donee has it for more than a year. And the donee, the daughter, will keep it and know it and have the value of 10,000. No difference. Basically, the government doesn't want to lose their gain tax just because you gift your stock and you're trying to avoid the tax, perhaps. So when it's pretty straightforward, whenever the value of the item goes up, then the one that's receiving the gift keeps the lower basis, which isn't nearly as good. You're going to have to pay tax, because if you turn around and sell it the next day for 12,000, the fair market value, you're going to pay a $2,000. You're going to have a $2,000 gain, and then any tax consequences that come from that. Now, it's not nearly as straightforward when the donor's basis is higher than what it is when they gift it to you. So back to a 10,000, but now instead of being 12, the basis of the stock has lowered down to 7,000. And we can only really know the basis and the gain or loss when it's finally sold by the one who received the gift. So here's some examples. If you turn around and you hold it for a little while longer and the stock goes back up to 12,000, you will then use your donor original basis. So if the stock goes back up above your donor's basis, you can disregard this amount, which is good, and record your gain is only $2,000. You sold it for 12, having the basis still of 10. And the holding period would be the same, would be whatever the donor is, probably long term. If you sell it for less than the 7,000 that you received it for, say you get it for 6, then what happens is you use 7,000 as your basis, you use what you actually got it for, and you only get a $1,000 loss instead of 4. So it would have been better if the donor would have sold it at the 6 or even the 7,000 when they gifted it to you, and took the loss, took that $3,000 or $4,000 loss depending on when they sold it, and use that, because now you only get the benefit of 1,000, the 7 minus the 6, and your basis begins when you receive the asset, because you're using a brand new basis. Therefore, your holding period begins when you received it. So you very well could have a short-term gain or loss, and when it's a loss, it doesn't really matter if it's short-term or long-term. If it's in between, let's say you turn around and you sell it for 8,000 or 9,000, then it's considered a wash, and you neither get a gain or a loss. And so if it's 9,000, basically you lost out on the original donor lost out on 1,000, because you don't get the 1,000 and they don't get the 1,000. Because note here in my little item, the donor, when they give a gift, they never record a gain or loss when gifting. All right, so we're going to try these examples. Stock was purchased a long time ago for 500. The owner dies, and the stock is now worth 40,000. Huge gain. 6 months later, the stock sells for 43,000. The heir is single with a $50,000 taxable income. So with 50,000 taxable income, we know they're in that 15% bracket for capital gains. I want you to pause and think about what kind of tax treatment would happen here in example D. All right, with this one, we have a long-term capital gain because we get to use the stepped up basis because it's an inheritance. We sold it for 43. We get to use the date of death basis of 40,000. So that leaves only 3,000 left of capital gain. And with this person being, let's see, what were they? Were they married or single? Oh, they were single. So I do need to change that. The capital gain, because if we go back up for $50,000, even if we take the 3,000 out because it's long term, they're still going to be at 47,000. So the 47,000 puts them in the 15% range. So I'm going to update my answer. That $3,000 will be taxed at 15%. So the key takeaway here is the inheritance is always long term. Inheritance doesn't matter if they bought it 2 months ago, or in this case, 30, 40 years ago, it's long term. Okay, so for example, E. This is a gift. The father bought the item originally in '97 for $10,000, gifted it to his daughter in 2018, and it's now worth $15,000. A couple months later, the daughter sells it for $18,000. Daughter is single with $50,000 taxable income, which includes, I'm going to put any gains, but not losses. What is the gift basis, holding period, and her tax liability? All right, so go ahead and pause, and let's think about, and I want you to think about how this is going to affect her tax return. Okay, so with this one, since the fair market value was higher than the original basis, the daughter automatically is going to use the father's original basis of $10,000 as her basis, and she then gets to keep the original holding period, which would be long term. She's deemed to have had it those entire 20 years. So she's going to have a long term capital gain of $8,000. And that capital gain of $8,000 is going to be taxed at that 15% rate, in that because she is single and she is going to be at that higher amount. That $8,000, even if we subtract out $8,000 from her taxable income, she's still going to be in the range to be 15%. Now, when I say your taxable income, that we're still going to look at, I've kind of been misstating that all along. If I would go and subtract out I don't subtract 8,000. When I go back up, let's go to back to our chart. I shouldn't have been saying all along that we're going to subtract out and then look at this, because this is all depending on our taxable income with the gain or losses. So when we're at 50,000, we stay at 50. Even if we take it back down, then that doesn't mean that we get to then have a lower taxable income for this chart purposes. All right, so now do the same thing with example F, except with example F, notice the fair market value of the stock has dropped from the original basis time. So it was at 10, now it's only at 5. Same tax treatment here, but the two instances are the daughter turns around and sells it 3 months later for a huge, it went way back up, or the daughter sells the stock and it continued its plummet down. How is each of these situations going to differ for tax purposes? So we're going to take a look at that. Go ahead and pause, and then we'll look at the answer for F. All right, for part A, if she sells it for $18,000, she's going to be able to then keep her dad's original basis. She's not going to have to use hers, which is a good thing, because if she used hers, that would be a gain of $13,000, whereas right now it's just a gain of $8,000. And she gets to use the dad's basis, his holding period, which would be long term. So she would have a long-term gain of $8,000. And let's bring that up. There we go. And that $8,000 would be taxed at 15%. What I guess I didn't do on E, if you wanted to go back up, this is kind of useful to do. It's just a way to hone in and ingrain this idea when you have the capital gain of 8,000. So we are in that 15% bracket. That was the cutoff because we see where we're at 50,000. But then we subtract out the 8 and we actually go into the book and look up 42,000. And if you look up 42,000 for somebody who's single, taxable income, because you get to take out that 8 when you're actually looking up their amounts for tax purposes. So they owe 51.85 and then tack on 15% of that 8,000, which is another $1,200. They're going to owe 63.85. And you can compare this number, compare it to look up actually $50,000. If you look up 50,000 for somebody who is single, it's going to be just a little bit more than this number. Not a lot, because remember they're on the low end of the savings, so they're not going to save a whole bunch, but it is a little bit, and a little bit's better than nothing. So this person did save, but not terribly amount. All right, on F, the second part, her basis is 5,000 because she sold it for $1,000. So at $1,000, she is then going to use her basis as her starting point. Therefore, she has 5,000 minus, or she sold it for 1,000 minus her basis of 5. So she gets to record a loss of 4,000. 3,000 being recognized this year, and then the remainder, the 1,000 that's left, carries forward to the next year. Okay, when you sell your house, there are some special rules about when you sell your house. A very big, important rule that is a really big benefit to homeowners is if you have lived in your home for at least 2 years out of the last 5 years, you can exclude, and that means forever. It's not just like put off and it'll come back later. You can exclude up to $250,000 of a gain on the sale of your home if you're anything other than married filing joint. If you're married filing joint, you can exclude up to $500,000. And so this is going to really, for 90% of the people who have a home that's not going to go up by more than $250,000 or $500,000 over the course of when they bought it to when they sold it, that would only happen if you're somewhere in a high ritzy area. You're almost never going to pay a gain on the sale of your home, which is a huge benefit. Now, the only downside is, just like any other personal use assets, if you sell your house for a loss, you cannot record the loss. So the overall point is, whenever you sell your home, 95% of the time, it's not going to go on Schedule D, because you only record it on Schedule D if your gain or loss is over these amounts. Now, the weird thing would happen then is, if you did have a large gain and you had your home for less than the 2 years, you are allowed to prorate the excluded amount. So this 200, let's say we're single, 250,000, and if you lived in your home for only 1 year, you could prorate that 250,000 for the amount of time you had the home versus the full 2 year amount, the 24 months. And so you could take this number in half. Essentially, when you have the home for only half the time that's required, and you could still write off 125,000 of gain, which it's hard to imagine that ever really happening. The only stipulation is, if you do leave your home before the 2 year period, it has to be for one of these 3 reasons. If it's just because you wanted to move, that doesn't count. Then you don't get the exclusion. You would have to record the gain on your home. But if you change jobs, you had health issues, and you had to move somewhere in a better environment, or in any unforeseen circumstances, that could be very vague. So you could probably get away with a lot of issues there that the IRS would have a hard time being able to fight it. All right, so my 2 examples We sell our house for $200,000. We bought it in 1950 for 40. How much gain can be excluded on this example? So go ahead and do this one, and then H. Go ahead and pause the video, and then we'll go through the answers. Okay, so with this one, with G, we have a $160,000 realized gain. That's how much our value of the home went up. But we get to exclude all of it because we've lived there way more than 2 years. And we can exclude, and it says, it doesn't even, oh, this person's single. So we could exclude up to 250,000. We only needed 160. So all of it is wiped out. No need to record this, and you should not record it on Schedule D. Everything's the same except on H, we only had the home for 6 months. So we have to prorate that 250,000. We can only exclude a fourth, so 6 over 24, a fourth of the 250,000. So we can only write off 62,500 of the gain. Still, that's better than nothing, because instead of recording a $160,000 gain on our books, we now only record 97.5 as recognized gain on our books for H. All right, now switching gears to the business side. Before we were talking about mainly stocks. Now we're looking at it from a business standpoint. If we sell items in our business, and this could be any type of regular business machines, office furniture, things like that. As long as we've held the item for more than a year, it's going to be considered a Section 1231 asset. And the good things about Section 1231 assets is you're able to treat any gains as capital gains. So you treat them with the special tax rates wherever you fall for your business. And then any losses, you get to subtract completely against your business net income. So you get to subtract all of the losses instead of only up to 3,000. You can take all of the loss that you have against your regular net income business. So it's a big benefit in business to have your item for at least a year, and then they're all of a sudden considered a Section 1231 asset. Now the limit is, well, what about depreciation? Because depreciation is going to lower your basis of your asset and therefore cause you to have a lot higher gain potentially. Well, then the rule comes a little bit more foggy, because what happens is anytime you depreciate, the amount that you depreciated, you have to actually add that back at a regular rate, at your normal rate. That's called depreciation recapture. And then anything above the depreciation that you took can be used at the Section 1231 special capital gain rates, just like what we've talked about above, where you're either 0, 15, or 20%. Let me give you an example of what I mean by this recapture. If we had a car in our business and it was worth 10,000, but we fully depreciated it using Section 179 or the bonus depreciation. So when we do that, we get a $10,000 savings automatically right there, right then, and we get that at our regular rate. We get to take that off of our income, and let's say we're in the 32% bracket. So therefore, basically, we're saving 32% of tax. Then in year 2, let's say the next year I sell the car for 7,000. So our basis is now 0. I've completely depreciated it. Our gain then would be 7,000. It would not be fair if I took and I only was taxed on 15% of the 7,000 instead of the full 32%, because that's what I got a deduction on. So therefore, it's kind of like cheating the system, and that's where they have this depreciation recapture that says if you depreciated the item, you're going to have to add back that depreciation. Any kind of gain that you have, you're going to be taxed at regular rates up to the amount of depreciation you took. So let's look at these 2 examples. The Section 1245 recapture, this is for basically all your property except real property, any buildings, apartments, things like that. And it's basically what this says is the gains, any gain you had will be treated as ordinary income up to the amount of depreciation claimed. And then any additional amount is considered a Section 1231 gain. Okay, we're going to do an example of that in a second, but I wanted to then explain, well, if this is for everything but real property, what's the difference then if it is real property? If it's real property, it's considered a section 1250. So you can just see the numbers, only 5 different. That's just the section number. Section 1250 property, everything's exactly the same as 1245, except gains that you had written off because of depreciation will only be added back up to 25% tax rate. So even if you're in the higher tax bracket, say like 32 up to 37% tax rate, you only have to recapture it at 25%. Basically, this is a gift for the very wealthy, as I must say. Because if you have to add it back at your rate of 22%, you get no benefit, because you took it off at 22%, you add it back at 22%. But if you're in the 32% bracket, you took it off at 32% with the depreciation. When you add it back, you only have to add back up to 25% for tax purposes. You only have to be taxed at 25% instead of 32%. So it's basically a gain on those. It's basically a benefit for those of the more wealthy. And then if you sold it for more than it was actually worth, that you depreciated, it is considered a section 1231 gain, and you get to use the special gain rates. So the overall rule here, something that you'll want to remember, maybe put in your notes for the test. The depreciation recapture, the amount that you have to add back at the regular rate, is the lower of the gain that you find, the realized gain or the depreciation total, but whatever the one is lower. Okay, so let's walk through I to take an example. We have personal property and machine in our business. Remember, personal property is different than personal use. So this is actually a business type asset. We sold it for $2,000. We bought it 4 years ago for only $1,000. So we actually sold it for more. We took $600 of depreciation. We're in the 32% tax bracket. How is the income taxed? All right, let's go through these 4 answers. What is the book value at the time of sale? All right, well, the book value is just like how you would have done in Accounting 101. What you bought it for minus the depreciation. So our book value is $400. What's the gain or loss then? The gain or loss, if it's worth $400 and I sold it for $2,000, my gain is $1,600. How much depreciation recapture should we claim? When we go back up to these rules, the lower of the gain was $1,600. The depreciation total was only $600. So the lower of those two is $600. So the depreciation recapture that I tax at my normal rates, at the normal 32%, would be $600. And then the amount that I tax at my better rates, at my section 1231 rate, is everything above the original purchase price. So we've made an extra $1,000 above and beyond the original purchase price, and we get to tax that at the capital gain rates. And us being in the 32% bracket, basically we're in the middle to upper even perhaps, but we're still at 15%. We're still in that middle rate. We wouldn't get up into the high rate until we were at the very top tier tax percentages, tax rates. Okay, so basically the rule of thumb is if you sell your asset for more than what it was originally purchased for, then you're going to be able to take a section 1231 capital gain. If you sell it, if I would have sold it for $800, I wouldn't have taken any of the special rate because it would have all been a depreciation recapture. If I sold it for $800, that means I would have had a $400 gain, and then we take the lower of the gain for the recapture, the lower of the gain or the depreciation total. My gain would have only been $400. My depreciation was $6, so the lower of those two is $4. I don't have anything left for section 1231 special rates. All right, let's finish out. I want you to go ahead and pause and do the same thing with examples J and K, and let's see what you get for your answers. All right, for example J, we sell the machine for $3,000. We bought it 4 years ago for $4,000, so we're automatically selling it for less than what I bought it for. So I can tell right away that I'm not going to have any Section 1231 rates. Any type of gain is going to be all depreciation recapture, taxed at my normal rate, so I get no benefit. I depreciated the item for $3,000, so that makes its book value. My first question, what's the book value? 4 minus the 3 would be $1,000. So my gain or loss would be the 1,000 that it's worth, and I sold it for 3, so I have a gain of $2,000. What's the depreciation recapture? The lower of the gain or the depreciation. The gain is 2,000, the depreciation was 3. So my depreciation recapture is only the amount of the gain, the 2,000. I have no gain left to do at the Section 1231 rate, so the entire 2,000 is considered a depreciation recapture. Okay, so I had taxable income of 75,000. We're going to now answer question D. What is the gain tax and what is the tax liability? Couple is married filing joint with taxable income of 75,000, including Schedule C income, but before any gain or loss from this sale. Okay, so 75,000 married filing joint. Let's go up here to our tables. We're really close to our limit point, and we would want to go ahead and add in that gain. So we're at 77,000. We're still at 0%. However, it doesn't really matter because none of this was special. None of this was a special gain, meaning a Section 1231 gain. It was all regular gain. So what I have to do is that 2,000, I need to add on to my taxable income. So 75,000 plus the gain, which was 2,000. It's a regular depreciation recapture, so I tack it onto this number. I then look up 77,000. So all 75 plus the 2,000 is taxed at regular rates. Nothing is at 1231. So when you look up 77,000 in the book for married filing joint, you should find that it's 8862 is the amount of tax liability that this couple owes. All right, our last item. Purchased a vehicle in May or April of last year in 2017, $20,000. Decided the business didn't need it and resold it only a year and a half later for $25,000, actually went up. $3,000 depreciation taken over those 1.5 years. Married filing joint, taxable income of $85,000, which includes everything except any gain or losses. What is the gain or loss treatment and what is the tax liability? Basically, you're going to answer these 4 questions again. And then the final one, D, being, let's see how you do. Go ahead and let's see how you do. What is your actual tax liability that you get? Pause and then we'll see. We'll check your answer versus what I have. All right, so our book value, we purchased it for 20. We've taken 3,000 depreciation, so that leaves us with a book value of 17. We sold it for 25,000, so our gain is $8,000. Now, how is that 8,000 going to be affecting this number? Because notice this number does not include any gain or losses from the sale. Well, so the depreciation recapture, that's the first thing we have to do. We have an $8,000 gain. The lower of the gain or the amount of depreciation taken is our recapture. So the first 3 is going to be added into this number and taxed at regular rates. So what you should have done is looked up in the back of the book, 88,000 for taxable income for married filing joint, and then the amount of gain plus this, so the full amount would have been 93. If we go up here to 93,000 as in our charts, we're in this range. So our taxable income of 93,000, that includes all gains, puts us here at 15%. So any type of Section 1231 gain, we're going to be at 15%. So that 5,000 that was left, the price that we sold it over and beyond what I bought it for, that's going to be taxed at that special 15% rate. So we're going to look up 88,000 in the back of the book, figure out what the tax liability is, and then add in 15% of 5,000. So our final answer here for K, I skipped some of the steps because we just talked through them. But oh, I don't think I updated this answer very well. Where is my answer? Oh, I don't have it. All right, so we're just gonna redo this because I haven't updated this one with my new answers. All right, so the gain is actually 8,000, and remember we took 3,000 at normal rates, and 5,000 of it at Section 1231 rates. So what we need to do is take the 85,000 taxable income plus the $8,000 gain. That's how much is our new taxable income temporarily. So 93,000 is our, I'll put temporary taxable income. But what we actually look up, we take the 93 minus the $5,000 Section 1231 gain, and we actually look up 88,000. We want to find the tax liability and then add in the 15% of the 5,000. Okay, so if I'm going to just take a few seconds here, look up 88,000 in the back of my book for married filing joint. 88,000, I get 11,245 tax liability plus the 5,000 Section 1231 times 15%. 5,000 at 15% would be $750. So 750 plus 11,245 takes us almost to 12,000. 11,995 would be our final answer. Okay. With that, I have some problems for you to try that are at the back of the chapter. If you look in the answers, the ones that'll pop up within a couple days, if you're before Thursday, I usually have the answers pop up by Thursday. The answers to some selected book problems, there are some good ones to try and see how well you do before you actually attempt the homework. Well, I'll go ahead and put the numbers here. The ones that to look at are 41. So let's write these down. Book problems to do 41, to practice on 49, 54, and 55 part 2, because actually 55 part 1 is part of your actual homework. 55 part 2. These are the ones to go ahead and try on your own, and then the answers, I'll have those posted as we get through the week. Okay, with that, I will see you next week for our final new lecture.